continue. Good morning, everyone, and thank you for joining us for Zeifmans Non-Residential Digital Event Series, High Net Worth Edition, Legacy, Preservation, and Optimization. I'm Aleena Benish. I'm a Senior Manager here at Zeifmans. First off, a little bit about Zeifmans. We are a full-service tax, accounting, and consulting firm based in Toronto, Canada. We support over 9,000 clients through every step of the business. Our services include business advisory, valuation, corporate finance, transaction services, corporate turnaround, and insolvency, and estate and succession planning. Please feel free to ask any questions, and we'll try to get to as many of them as we can at the end of the interview. And with that, I'd like to officially introduce our guest, Mike Dolson, Barrister and Solicitor and Partner at Felesky Flynn. Mike, tell us a bit about yourself and what you do.
Thanks. Yeah, so I think as you mentioned, I'm a tax lawyer and I'm a partner at Felesky Flynn in Edmonton. I'm originally from Mississauga, so it's kind of Zeifmans is in my home territory, so to speak. And yeah, so I practice in all areas of corporate and personal tax, but primarily dealing with cross-border transactions, so inbound and outbound investment from the US and into Canada and vice versa.
Awesome. All right, so then let's get the questions rolling. What are your key differences, from a legal standpoint, tell us a little about tax structures relating to foreign investment, how to minimize tax as a non-resident, and how to capitalize on setting up a Canadian business.
Yeah, for sure. So, I mean, there's obviously thousands of different structures that you could create when you're having a non-resident invest in Canada. I understand that since our larger event today that Zeifmans is putting on involved Hong Kong, I sort of thought I would focus on real estate investment, since that's where our firm primarily sees investment by Hong Kong residents who are not planning to immigrate to Canada at the end of the investment process. And so, with real estate, how much structuring you really want to do, what kind of structuring you're really going to do, depends a lot on how big the investment is going to be. The reason for that is that under our tax treaties with various jurisdictions, Hong Kong included, Canada doesn't really cede our right to tax income from real estate or capital gains from real estate. And so what you're doing is really working within the Canadian rules as opposed to doing anything crazy elaborate. So in the most basic situation where a non-resident wants to purchase and then lease out a condo in Toronto or Vancouver, probably the simplest thing to do, and maybe the best result you're going to get at all, is to have the non-resident incorporate a Canadian corporation that will act as a rental agent, and to then have the non-resident personally acquire the real property and lease it via the rental agent corporation. So provided that the appropriate elections are made, then the result should be that the non-resident will be taxed on a net income basis, and there should only be any Canadian tax withheld at the point that that net rental income is remitted to the non-resident in their home jurisdiction. So because you're taxed on a net basis, for most non-residents, this is going to result in very little or no Canadian tax payable after they've taken their deductions for common expenses, property taxes, mortgage interest, and and those sorts of things, including depreciation deductions, which can zero out income all the way. If the non-resident investor is going to make a larger investment, but will nevertheless not be engaging in activities that would constitute carrying on a business in Canada, then again, a fairly similar structure works, but in this case, you might want to look at having a non-resident corporation acquire the Canadian real property, and again, with a Canadian resident corporation as a rental agent. So again, assuming that the correct elections are made, this could permit the non-resident corporation to be taxed on a net basis with no Canadian tax withheld until net rental income is remitted to the foreign corporation. And the foreign corporation would not have to deal with withholding taxes or any of that when it transfers money out of Canada or when it pays a dividend to its non-resident shareholder. So that's, again, a pretty good result. And the nice thing about that versus just the personal investment is that you can pay tax in Canada at our corporate rates, which are generally much lower than our personal rates. So any residual income that you can't get rid of with interest and CCA deductions will get taxed at approximately 25%. If the non-resident investor is going to be making a much larger investment in Canada, or is going to be investing in something that could constitute carrying on a business in Canada through real estate, such as a hotel, a shopping center, a retirement home, or a farm, then again, there's a slightly different BEST structure that you might want to do. Again, it involves having a non-resident corporation acquire the property directly and a Canadian resident corporation that will be in the picture. But what will happen is that the Canadian resident corporation, in this case, will be responsible for operating the property and operating the hotel, etc. But it will lease the property on a triple net basis from the foreign corporation. And again, with the right elections, permits net income taxation, should ensure that there's only Canadian tax when net rental payments under that triple net lease are made. And again, we'll ensure that the Canadian tax rate should not exceed our sort of average 25% corporate tax rate. Beyond that, investing in Canadian real estate involves a lot of the same tax planning decisions as investing in any other kind of Canadian business. So one of the key things to think about is leverage, using interest expense to drive down your Canadian tax. However, you do have to be careful with leverage. We do have thin capitalization rules that can apply to foreign corporations as well as investments through domestic trusts or partnerships, where the debt to equity ratio exceeds 1.5 to 1. And that could result in the denial of an interest deduction and a deemed dividend. So that would be subject to Canadian withholding tax. So not an altogether great result, but those rules are fairly static, so it should be easy to control whether you have a problem there. Beyond that, if you assume that interest is deductible, then you then get into Canada's withholding tax rules, and you will have to think about withholding taxes. Generally speaking, interest is paid to an arm's length non-resident person is not subject to any Canadian withholding tax. However, non-arm's length interest payments may be subject to withholding tax. Under most of our tax treaties, this withholding tax rate gets reduced. So for example, under the Canada-Hong Kong Treaty, it's reduced to 10%. However, there are some exceptions to this that people will need to be careful with, for example, for participating interest, and as well, our domestic back-to-back loan rules could cause the withholding tax rate to be higher if you're using a conduit jurisdiction. And similarly, the principal purpose test that has recently been added to most of Canada's tax treaties could again apply to cause the withholding tax rate to be higher if there's a conduit in a third jurisdiction.
Okay, great points. So we'll roll into the next question. What are the key differences between setting up a non-resident versus a resident best practice tax structure?
Yeah, so the primary difference is that non-resident structuring, what we're trying to do is we're trying to cause as little income as possible to be taxed in Canada. And as well, we're trying to make sure that any income that will somehow be taxed in Canada is subject to tax at a relatively low withholding tax rate rather than at our normal Part 1 income tax rates. So up to kind of 53% for individuals or up to 31-ish% for corporations. So that's what we try to avoid by and large by causing income to be shifted into foreign jurisdictions. In contrast, for domestic tax planning, Canadian residents are taxed on their worldwide income, and our rules for controlled foreign affiliates, non-resident trusts, and offshore investment funds are reasonably tight. So as a result, tax structuring for Canadian residents is generally an arbitrage exercise, where what we're trying to do is cause income to be realized in a form that is more advantageous than others, or in an entity that's more advantageous than others. That's the magic. Usually you're not going to try to cause the income to not be realized in Canada.
Okay. So how is the non-resident operating in Canada taxed, relating to investment income as well as active income?
Yeah, so we've already talked about real estate income, so I'm going to confine my comments here to non-real estate income. So with investment income, the answers are going to be taxed very lightly and potentially not at all. assuming that they earn the investment income directly, and it's not through an intermediary Canadian entity, like they haven't incorporated a Canadian corporation to hold their investments, for example. So, suppose that we have a non-resident, doesn't really matter where, but resident somewhere other than Canada who just holds securities in a Canadian brokerage account, which, from what I understand, is relatively popular to do. So in that case, the expectation should be that the only Canadian income that's actually going to stick is going to be some dividend withholding tax that would be payable by the non-resident when a Canadian resident corporation pays a dividend that's received by the individual. Otherwise, any interest that they receive on portfolio debt securities should be exempt from Canadian withholding tax, because the non-arm's length person will be the non-resident person will be dealing at arm's length with the Canadian payer. And similarly, any capital gains that would be realized in that investment portfolio would be exempt from Canadian tax, because the non-resident person will not be deriving those gains directly or indirectly from Canadian real property. If the non-resident earns business income in Canada directly, then we really have two questions that we have to ask ourselves. The first is a non-resident resident in a treaty jurisdiction, meaning a country with which Canada has a bilateral tax treaty? And second, we have to ask ourselves, is the non-resident carrying on business through a permanent establishment, or PE, in Canada? And so if the answer is that they're not resident in a treaty jurisdiction, so they're resident somewhere, like the Cayman Islands, let's say, where we just don't have a tax treaty, then if they're carrying on business in Canada, the result is that they're going to be subject to tax in Canada on the same basis as a Canadian resident person would. And we do have some means, like withholding on services payments, for example, to make sure that the tax is collected. If they are resident in a treaty jurisdiction, however, then, like I said, the question shifts to whether or not they're carrying on business through a permanent establishment in Canada. If they aren't, then the income that they're generating from the business in Canada that's not carried on through a permanent establishment is just exempt from Canadian tax under the treaty, and so they don't have to worry about it. If they are carrying on business through a permanent establishment in Canada, then again, the result is that they're going to have to pay Canadian tax on substantially the same basis and at substantially the same rates that a Canadian resident person would pay tax. There are some rules in the treaty that deal with allocation of income to permanent establishments that might cause some amounts to be deductible or just not included in the permanent establishment's income, but generally speaking, substantially the same basis as the resident person. This idea of a permanent establishment, or PE, that's detailed in Canada's tax treaties. Generally speaking, any kind of fixed place of business in Canada, like an office, factory, mine, etc., is a permanent establishment, as are some longer-term construction sites, for example. And in some cases, if you have employees who are situated in Canada and who have the ability to conclude contracts on behalf of the non-resident person, that could also constitute a permanent establishment in Canada. That being said, if you're carrying on a digital business, so for example, if you're Amazon or your Facebook or something like that, or you're just generally selling goods or services to Canada completely online and without any kind of physical presence in Canada, it's usually pretty straightforward to avoid our permanent establishment rules. And so you may be able to just make sure you avoid Canadian tax by avoiding the creation of a PE, which is fairly easy to do. The OECD has some current proposals right now called Pillar 1 and Pillar 2. Pillar 1 might change that result, but that would only be for entities with consolidated group revenue of more than 750 million euros. So probably not especially relevant to most high net worth individuals.
Okay. With that, we come to my last question. As a non-resident, what does one need to do to avoid being construed as a Canadian citizen?
Yeah, so really, Canada doesn't care very much about citizenship for tax purposes, but we really care about residence. And so Canada is a bit different than a lot of countries with which people might be familiar, in that we have both a day counting residence test and a more nebulous facts and circumstances residence test that's based on our common law. So for example, if you're physically present in Canada for 183 days or more in the year, you'll be deemed to be resident in Canada under our domestic law, whereas we have just a very squishy test under the common law where you can be resident in Canada just as a matter of fact if you have some substantial connections to Canada. Layering on top of this, we have our tax treaties with various jurisdictions which can override the domestic law and can deem somebody to not be resident in Canada even if they were resident in Canada under our domestic law. So in a very general sense, if an individual does not live in a treaty jurisdiction, the way to avoid being treated as a resident in Canada or having any allegation that they're a resident in Canada is to just spend as little time as possible in Canada, and especially do not spend 183 days or more in Canada in the year. If the non-resident person has ever been a resident of Canada in the past, then they should also certainly not acquire real property in Canada other than real property that they can lease on a 12-month or longer lease to an arm's length person. And they should also not allow their dependents, like their spouse or their children, to become resident in Canada. It's probably okay for a non-resident person who's never been a resident of Canada before to acquire Canadian residential property for their own use if the use of the property is occasional and infrequent. So sort of like a vacation home, right? There's no reason you can't acquire a condo in Vancouver to use when you're infrequently in the country for vacation, or a cottage in Muskoka or something like that. If the individual is resident in a treaty jurisdiction, then they can, as a bright line matter, avoid Canadian tax by never having a permanent home, whether owned or leased, in Canada. If they do end up with a permanent home in Canada, then it's just a matter of doing two things. The first is making sure that they remain resident in the other country under the domestic laws of that other country, and also making sure that they can establish that their spouse, children, jobs, social networks, significant assets, etc., remain centered on that other jurisdiction and not centered on Canada. And that should be enough for them to be deemed to be resident in the other country and deemed not to be resident in Canada under our tax treaty with that other country.
Awesome. Thanks, Mike, for that great information. Any closing remarks? I have some questions.
I don't really have anything. I think it's just been, it's been a blast to do this, and thanks for having me on.
Yeah, absolutely. Thank you for joining us today, and thank you everybody for tuning in. And if you have any more questions, just contact our Zeifmans team. You can just click the link in the bio and connect with us today. Thank you again, Mike, and take care.